Welcome to PhillipCapital's Weekly Market Watch. The likelihood of a back-to-back recession got a lot more attention recently as economic indicators of major economies continue to pull back from the highs during the recovery. What are the possibilities of a double dip? Today, we have with us Ms. Hilary Ho, investment analyst from Phillip Securities, to share with us. So Hilary, China has recently announced a decline in growth from the previous quarter. What have caused the decline?
Okay, China announced that its economy expanded 10.3% year-on-year in Q2 2010, down from 11.9% in Q1. Consumption's contribution to GDP growth has fallen to 3.9% in the second quarter. On the contrary, the level of contribution from net exports has risen from the first quarter. Net exports contribution to GDP growth rose from -1.2% to 0.6%. This did not come as a surprise, as exports grew by 43.9% year-on-year in June. This was in addition to the 48.5% growth in May. At the same time, imports growth slowed to 34.1% year-on-year from 48.3% in May.
Is China at a policy turning point?
Okay, on the whole, we think that there is a need to recognize that while growth has slowed, it is still remarkable relative to other economies, and even those in Asia. With Singapore as an exception. Okay, as such, the Chinese might probably be reluctant to reverse its tightening policy at this moment. Besides, it is also important to note that businesses have recapitalized, household net wealth and income levels are rising, and monetary policy is still extraordinarily accommodative at this point in time. With the Western economy showing signs of slowdown, the Chinese authorities might be reluctant to tighten further. This is on the assumption that property prices continue to decline. All in all, we think China is probably on a neutral stance currently.
The US economy is showing signs of slowdown too. What is the likelihood of a back-to-back recession in the United States?
Okay, at present, a double dip scenario seems unlikely, as data is suggesting a slowdown in growth and not a contraction. For instance, although the ISM index for June pulled back to 56.2 from 59.7, it remains above the 50-mark threshold. Readings of 50% or above is associated with an expanding manufacturing sector and healthy GDP growth. Nonetheless, it is actually inevitable that growth in the US will slow in the second half of the year as the boost from the fiscal stimulus and inventory rebuilding fades.
Despite the softening of economic data, equities have performed relatively well. Where do you see equities heading in the near term?
Okay, I think in the month of July, investors have been torn between upbeat earning news from companies and reports that point to an uncertain recovery. Despite so, major equity markets were up approximately 8 to 11%. Southeast Asia region continued to perform strongly against other regional markets. In the near term, we believe this region will carry on performing. From a technical perspective for our local market, the near-term resistance for SDI stands at the 3,000 to the 3,037 region. 3,037 is actually the high for the year. On the other hand, for the US market, the near-term resistance is approximately at the 11,126 mark.
Thank you, Hilary. That's all we have for you today. Tune in next week for more market updates.